Good afternoon. This is Anthony Mento here from Life Brokerage as the clock strikes 12 here on the East Coast, and a good morning to our friends on Central Mountain and Pacific time. Thank you for taking a little break from your quarantine. I'm sure you are webinar and conference call fatigued, so I'm going to make this fast. It's going to be action-packed. Today's broadcast will be recorded. You'll receive a recording within 1 to 2 hours from the close of this meeting, and copies of the PowerPoint slides will also accompany that recording. So, as we look to continue to evolve our businesses and generate sales activities, we have taken a very careful look at the last 60 days and business that we have been securing through applications, larger ticket items, and we've been able to identify 3 or 4 very successful strategies that we wanted to share on this broadcast today, and then forward think a couple additional strategies that we think will be applicable utilizing some of the new tax laws, the Secure Act, CARES Act, and PPP. So, just because we have a 30-minute window here, I'm going to ask that you type your questions in the question control panel section of the control panel, and we promise if we don't get to every question today, that we will reach out to you individually and address those questions. So let's dive right in. Today's agenda. E-capabilities very quickly, COVID consideration programs. We're writing some larger ticket items using the COVID consideration plans, and I can tell you that our volume has tripled due to e-capability. So we are seeing higher volume, smaller average case size, and then the larger tickets are getting pushed through the COVID consideration. We're going to look at some premium mitigation strategies. Look, it's no secret here. Businesses, individuals, they're concerned about their expenses. So why not take advantage of policy review tools that we've been using for years and years and look to mitigate premiums? These are some very creative strategies that I think you can employ with your practice. The slow demise of GUL. This is a somewhat depressing topic. You're going to see how the GUL market has evolved from pre-2017 CSO tables and premium-based reserving, which was, call it December of 2019, just a few short months ago, to post PBR 2020, how COVID has impacted the GUL market, and now how economic conditions with 10-year treasuries at 61 basis points are affecting the GUL marketplace. We're going to look at single pay MEX. This is a wonderful parking place for liquidity. You're going to see that we're generating returns that are equal to or greater than 10-year treasuries with upside of product caps, along with a pile of death benefit and long-term care benefits. Qualified Plan Max. We're going to dive into the opportunities surrounding Roth conversions using the new Secure Act, how life insurance coupled with a Roth conversion can be effective, and how the most effective plan, quite honestly, is to spend the entire IRA and purchase life insurance, which, of course, coming from a life insurance wholesaler, sounds quite common, but we have the economics here to back it up. Of all the software tools available to us in our industry, I have yet to find one that can do it on one page and take into account the 10-year deferral using the new Secure Act. So we think we're providing a solution as a value add here. The CARES Act, what you can do with $100,000 of leverage using the CARES Act relief. And forward thinking, what are we going to do with these PPP checks once they hit our bank accounts as business owners? And how do we avoid these issues going forward? So just a quick refresh. If you haven't been to the Life Brokerage website yet, we have created an entire landing page dedicated to the agent home-based toolkit. You'll see everything from the ability to push out an application to gather information that's form fillable to your client, to e-apps, to quoting, to what carriers are eliminating the need for exams, what carriers are doing it through consideration programs. If the client had physicals at their primary physician or specialist that include labs in the last 18 months, we're using those as consideration. And then step 4, delivery, right? Clients don't want to interface with us. They don't want to let an examiner in their homes. So here's a way to transact from start to finish, and even the premium collection, where we can use credit cards and or bank draft forms. So let's dive right in. All right, premium mitigation strategy. So everyone on the line, including myself, we're all very accustomed to paying level premiums, okay? There are some economic and immediate relief and long-term economic advantages to structuring non-level premium solutions. So here we have a male 64. Here's an opportunity to review client's policy. They own a term contract. They purchased 10-year term 5 years ago, and now we're looking at a level premium of $13,500, which equates to a total 5-year cost of $69,500. Very simply, taking the remaining years of a level term policy and swinging it down into an ART will provide immediate premium relief from $13,900 down to $6,400 in year 1. Yes, that premium will increase. However, the total 5-year cumulative cost is $59,340 versus $69,500, and we have in fact created a immediate premium relief and a long-term cumulative advantage to doing so. Next up, UL, or call it graded premium type designs. What we're looking at here is client is paying $67,000. She's a 61-year-old female for $8 million of coverage. This policy was purchased in 2015. You would think it's a GUL, it has no cash. She's 5 years older. You would think that there's no ability to create a savings. However, should the client be so inclined and be open to structuring graded premium designs, she can create immediate relief. In this instance, agent wanted a target premium, so we paid $92,000 in year 1. However, the minimum premium in year 1 was $20,000. So the paying target of $92,000 did help years 2 through 20, but we didn't have to pay the $92,000 20-year premium test. So I can use $7,000 of ongoing premium all the way, create immediate relief all the way to the low 20s, immediate relief of $40,000+, knowing we need to pay the piper later on. However, even with the annual premium increases, the IRR at age 89 is still significantly better, almost to the tune of 400 basis points. So immediate premium relief, better yield, more cost-efficient product. Okay, great time to be looking at these types of things. The slow demise of GUL, and this kind of, this kind of saddens me a bit, because this is a wonderful product. But let me just give you some facts and figures here, and think about this when you're considering, mining your book of business for term conversions. And that's the point of my dissertation here. So in December of 2019, every product had to be repriced using 2017 mortality tables, and products had to be built using premium-based reserving requirements, which means insurance carriers had to capitalize more tier 1 assets aside to pay future claims and support guaranteed elements of the products. So at that time, Life Brokerage, just our BGA, we offered 17 GUL products outside of New York. Inside of New York, we offered 6. When the product transition took place, CSO tables were implemented, premium-based reserves There were a lot of carriers who didn't feel like it was economically viable to continue to offer their GUL products or even longer duration terms like 30 years. And long and short of it is that our portfolio of 17 GUL carriers, some very high brand household names, was reduced down to 13. So we lost 4 GUL products just for between December 31st and January 3rd. In New York, we lost 1. So 4 doesn't sound like a lot, but 4 out of 17 is actually a 23% decrease in available GUL products. So fast forward to March of 2020, COVID-19 hit. 11 carriers of the remaining 13 GUL products imposed some type of limitation on the GUL. Maybe they capped out at age 70. Maybe there was a first-year premium cap of $250,000. Maybe they stopped abruptly. This happened yesterday. Stopped abruptly accepting 1035 exchanges. They stopped accepting certain rate classes above standard, above table 2, above table 4. This market and this product demographic was impacted significantly. And now forthcoming, we're getting transition notices from major carriers. 6 of them have announced that they're transitioning from their current pricing model to an increased GUL premium with an average of a 20% markup due to economic conditions and interest rates being as low as they are. So this is the time, if clients have ever thought about purchasing GUL or converting term, there is a huge incentive to do so, because quite frankly, fast forward 6 months from now, and we don't know what the market's going to look like, if there's going to even be GUL products available. So let me give you an example. Female 62, $10 million of GUL for life, best rate class. In December, her premium, what she purchased in 2019, was $142,000. Wait 1 month with an age change to 63, and that premium goes from $142,000 to $154,000. So, this is all relative. You turn this into a $100 million case at 10 times. You turn it into a $1 million case. You divide by 10. It's all relative. So there's an 8% increase. Doesn't sound like much at the time, but if you add up the cumulative premium increase between now and her life expectancy, you're looking at almost a $300,000 cumulative cost of waiting to convert 1 month. April 2020 premium schedules are about to be released. Again, it has been announced. I sit on 2 advisory committees for 2 major insurance carriers. It has been announced that on average, you're looking at a 20% increase. So again, take a look at the transition rules, call your marketer. You're going to get tons of follow-up from us, including the recordings, and we're glad to share with you the transition guidelines. Additionally, if you'd like to see this piece that we put together using probability of death, this is a really nice piece my partner Adam DeMarco created. It's called the Term Gamble, and it shows the probability of rolling the dice and maintaining term for the remainder of the duration. And you'll see here there's about a 5% chance of claim that this particular 47-year-old gentleman actually has a claim paid in this particular scenario. So if you invert that, you're looking at a 95% probability that he would lose his $33,000 of cumulative premium. Okay, so we touched on the depression of GUL. We touched on the ability to mitigate premiums in policy review. So let's talk about finding a place to store money, right? Let's look for a parking ground so that we can let this market settle out. There's a ton of volatility in the equity market. There is extremely poor yields in the bond market. So what do we do and where do we go? Well, these products have been available to us for some time now, but the inconvenience of purchasing them was that there was always blood and urine involved, and there was that yucky life insurance process that was attached to it. Well, guess what? Through COVID, the majority of that process has been eliminated. And we have shifted gears to an electronic version of underwriting, whether it be a phone interview or no interview at all, part 2, online part 2, we're skipping the blood and urine and fluids. So I'm going to share with you 2 products that fit this mold. Obviously here, they have superior guaranteed values, right? So whether you like IUL or dislike IUL, no one can argue with the values. So remember, we're looking at this as a parking ground. Should things work out, we're going to hang in there. Should things not work out, the product is liquid enough that you can leave. Obviously, the use of the long-term strategy benefits the consumer more, but for the naysayers, we're creating guaranteed values that are higher than risk-free investments in year 1. So product 1 is a single pay, has a floor of 0 and a cap of 8.75, and it comes with a chronic illness rider, which means you can accelerate the face amount if you can't complete 2 of 6 activities of daily living. However, it's a little more stringent. There's an actuarial adjustment off of the face amount. It's not a dollar for dollar reduction, but it's a nice feature to have. Again, the point of product 1 is to generate very high guarantee values and provide some upside with a cap of 8.75, and I'll get into a case study for you in a minute. And product 2 doesn't have as high of guaranteed values, but it does have a higher cap. It comes with a true long-term care rider, $26,000 a month. On the example that I'm going to show you, with a total long-term care pool of $1.3 million, very impressive product. So the demographic here, clients in a large cash position earning 61 bips and no legacy leverage to the product. Cash position is not effective for distribution, and they don't want to take market risk or tie up an asset in an annuity. So here's a single premium of $250,000 in example 1. You can see the guaranteed cash max charges, minimum account value of 0. If you walk away from this product, you get a retro 2.5% crediting rate. So your true guaranteed walkaway value is $250,160 on a $250,000 premium deposit. Now, this also comes with $690 of death benefit, so it pushes to $700 once you hit corridor on the far right. Surrender value, assuming the S&B hits a 5% crediting rate, again with a 0 and 8.75% floor, you have $257,000 of cash surrender value at the end of year 1. Very, very impressive product, a wonderful parking ground for liquid assets, so that if an opportunity arises or the markets settle in, you can pounce at any given time because these products are fully liquid. Asset-based comp, you get a little pop up front, but then you get some nice trails. The product I'm showing you here is more lucrative, higher targets, more heaped commission, but when you get heaped commission, you see that the guaranteed walkaway value in year 1 is $408,000. Now that assumes this carrier blows up the cost of insurance from day 1 and the S&P goes down. Very, very improbable, but in today's world, I still want to show you the guarantees. You'll see that contractually guaranteed, even with surrender charges, you'll start to reach your premiums deposited somewhere between year 8 and 9 with very little harm. Slide all the way to the right, you get a bunch of leverage, you got a bunch of cash value, you got a 10% cap on this product, and really cool, $26,000 a month, dollar for dollar, true long-term care, indemnity-based. So you're not submitting receipts, you're not haggling with caregivers, it's a true indemnity-based product. So really nice planning tool, great parking zone for liquid assets. Okay, I'm going to transition to IRA assets. So you will never be able to see this. These are complex sheets. So what I wanted to do is just speak to them in general. We've built a Excel template that gives you 3 different modules. Here's a female 76. She has $4.5 million in her IRA, and she's a New York resident. So what the modules will tell you is, or what considerations they'll make is, okay, do nothing, spend down your traditional IRA using RMDs, reinvest them, and implement the Secure Act 10-year deferral. So as I mentioned on the opening part of the call, we have yet to find a software package that demonstrates on one page the ramifications of Roth conversion, a spend down for life insurance wealth transfer, and a combination Roth conversion and life insurance on one page that takes into account state-to-state taxes, income in respect to the decedent, and the new Secure Act 10-year deferral. So I'm going to quote Ed Slott at the bottom here. If anyone was not aware, the Secure Act put the kibosh to stretch. So Ed Slott has been quoted time and life insurance, our IRA. And I'll quote him from a webinar he just did this week. Life insurance trusts can be customized to simulate the stretch IRA over any payout period desired. Buying life insurance in conjunction with a traditional IRA is a wonderful planning tool, and the software that we've built will demonstrate that. So after all the complexity of the prior spreadsheets, some 26, 27 columns long, we boil it down to a summary sheet, and you'll see it in year of death, year 15, 90 years old. You'll see that the net to heirs in the IRA spend down or the combo plan Roth plus spend down is far superior than any other strategy. I would echo Ed Slott's comments. Life insurance is the new stretch IRA. Very quickly, we're running short on time here, and I wanted to cover 3 more points. So the CARES Act provides relief. So coronavirus related. If you look on the left, it tells you what it is. If you look in the column to the right, it talks about the qualifications. I personally did this. I typically don't like to sell or promote things that I don't own. So let me just share with you some opportunistic strategies. The CARES Act will waive the 10% early distribution rule for clients not 59 and a half, prior to 59 and a half, up to $100,000. So you will still owe taxes on that distribution, spread evenly over 3 years. So if you take $100,000, you owe $33,000 of taxes this year, or let's say March of 2021 for this year. $33,000 next year, $33,000 the following year. So in essence, of creating a wait and see approach to determine, do I want to redeploy this $100,000 or do I want to put it back? Because the CARES Act does say you can repay this back over the 3-year period. Now, there are some minor qualifications. They're very loosely defined. I literally called ADP. In 13 seconds, I had a check being mailed out to me. Adverse financial consequence, yes, I'm being quarantined. That's enough. That meets the qualification. So there's some more harsh qualifications like being diagnosed with the virus or disease, or spouse or dependents being diagnosed with the disease. But there are also adverse financial consequences. And very simply, if your income changes even slightly from being quarantined, you may access $100,000 from your plan. So what does that do? And what opportunities does that create? Well, you can do a single premium transfer. Our friends at Principal pointed out that there's survivorship. GUL is extremely friendly to single pay. So you can buy a bunch of death benefits, second to die, to leave to your heirs. You can purchase one of the MEC designs that we just looked at. You can deploy the Be Your Own Banker strategy that we've talked about in prior webinars, which I'll touch on today briefly. And in my instance, number 4, I'm going to be looking to buy distressed assets. Right, there are blue chip stocks that are undervalued. We foresee some economic challenges in the commercial and residential real estate market. So cash in hand is a very powerful position at the moment. Okay, it clears up the CARES Act. Now, the PPP funds. So companies like Life Brokerage, we are going to see we're very, very conservative in nature. So had a pretty good balance sheet to begin with, eligible for PPP. We're expecting funds to get dropped in our account by middle of next week, and you're going to see a lot of business owners that are in a similar situation. The question is, what do you do with those funds? Obviously, if the company is distressed and needs them to survive and operate, then you're going to deploy them and you're going to keep them in a checking account. But as an alternative, right, a more sophisticated be your own banker strategy, which we've talked about in prior presentations. So what would stop anyone from dropping this into a business-owned single premium whole life contract, and then subsequently pledging the whole life policy to a local bank or vendor who publicly promotes the use of whole life working lines of credit? And I showed here deployment of a little over $2 million in column 4, pledging this to the local bank in columns 7, 8, 9, and 10 at a 4% interest rate, tax deductible, and then going out and growing your business or purchasing distressed assets or making payroll or doing whatever you need to operate efficiently, and simultaneously creating wealth in doing so. And what we show here is the breakdown of the prior slides, policy values, where we're creating cash-rich, whole life, subsequently pledging it to a local bank or a bank that, like Investors or Valley National, who openly promote the working line of credit whole life programs. And here you have the ability to go out and generate alternative investments using the leverage from your very conservative, slow-moving whole life contract that acts as the catalyst and collateral to the arrangement. And here you see long-term effects of reinvesting the borrowed funds from your local bank into alternative investments. So we covered a lot of ground here today. There are a few questions, so let me try and get to some of these questions. So question number 1. Which carriers have GUL? Can we convert to term to GUL? Absolutely. So again, there are still approximately 11 carriers offering GUL. We can certainly send you a list of products that have that convertibility. Companies like AIG, Principal, Prudential. There are several companies that enable the use of term to GUL. Additionally, what's interesting, there are some external conversion programs, and whereby Nationwide will accept any term policy from one of the named 20 plus companies and allow you to convert from that company to the Nationwide GUL, which is extremely favorable. Symetra has a 5-year external conversion program. So not only can you convert carrier to carrier, but sometimes there are very competitive products that allow a conversion to new company. So question number 2, MEC is the 7 times? Yes. Is the LTC rider unlimited? No. The LTC rider coincides with the initial face amount. So the 3-pay product that we looked at earlier in the slide had an initial death benefit of $1.3 million. Even though the death benefit grew significantly because we pushed corridor and grew to 6 and 7 million, the LTC pool is capped at 1.3 million, which was the initial face amount. Question 3, are there any current assumption UL or IUL with funds placed in the fixed account where the single pay MEC strategy works as an alternative? Yes. All of the products that I shared today do have fixed accounts within them, but we do have current assumption UL products that also enable a MEC strategy that is also effective. Clarifying point, yes, very good point. So, and the CARES Act solution, take $100,000, you have 3 years to pay the tax. I misspoke. I said we owed $33,000 each year. We don't actually owe $33,000 each year. We owe tax on $33,000 each year for 3 years. So, call it $11,000 taxation year 1, year 2, year 3. Thank you for that clarifying point. Great questions. There are a few more that we weren't able to get to, and we've reached 12:30. So you will receive very shortly a recording of today's call. In that recording, it will have a link to my calendar if you'd like to discuss anything further. Any questions we didn't get to, I will address one-to-one. And that concludes today's webinar. I thank you for your attendance. Stay safe, stay hungry, keep selling life insurance. Be well.